Hello and welcome to a new episode of Under 360 English. Today we are going to discuss about how to create a day trading plan, because all of us know that as a casual trader, if you just one day jump into the scenario of trading as an intraday trader, it may not be a fruitful one. Most probably it will be almost like trying your luck by taking some lotteries. So, just like any other process, you should try to make a plan as well as a process flow for trading, whether that's in an intraday equity trade or intraday F&O trade, or even if you are thinking that if you are a swing trader or even investor also need certain plans. At what levels you will enter, at what levels you will exit, at what time you will exit on hitting on the stop loss. All those things you should have a clear plan about your investments or trades. Else, in long run, you can't able to harvest much of the benefits that are offered by the stock markets. So stay tuned, keep watching. Theoretically, intraday trading is all about buying at low levels and selling at high levels within the same day itself. So these opportunities for buying or selling can be for a particular stock or a sector or even market as a whole in general. So the success of an intraday trader basically lies with identifying and taking the right position at the right time. And even that holds good for exit also. At the right time, you should be able to exit. But in reality, those who have done intraday trading, in reality, things are much complicated and things are not that much silly as we think. So one of the biggest hurdle for intraday traders have to face the tendency to get changed with the market sentiment. Their mindset will be changed with the market sentiment. While some traders get frightened with the market direction also, because for example, if you have taken a long position, if you have bought a stock but unfortunately the price of that stock is falling, in that case you have an urge to either get out of that stock or you may hold that stock forever. In either case, that won't be good for you as a trader. So if there is a buzz or boom due to some news or something like that in the market about a particular sector or a particular stock, most day traders are buying the stock of that companies in that particular sector or that particular stock itself. Some traders, they participate in the trend and some short sell such stocks playing against the hype. They don't want to go with the trend. But as an intraday trader, the margin of error generally that's very small. So a wrong pick of the stock or a sector or at the price may lead to heavy loss. So it is very important to have a plan to execute your day trading activity and keep close to your investing strategy. So this is the day trading plan that we generally mention. So day trading plan means it's a broad framework that allows you to make trading decisions that are well suited to you. So if you are still wondering about how to make a trading plan or how to create a trading plan, in that case, after watching this video, you will get some glimpse of it and some of these things you can implement in your next trading onwards. That will change your trading scenario to a very great extent. First, let's have a look on how to create a day trading plan or the steps to create a day trading plan. The first step is you should determine your primary motivation to become as a day trader. In one fine day, if you feel that your friends or your kith and kins, they are making good money from day trade, so today onwards I can also become a day trader. That's not the justification to become a day trader. Instead of that, you should justify your stand why you have become a day trader instead of an investor, or ongoing with your current job and go for investment and reap the benefits of that investment in stock market. Will that be beneficial to you? So you should sit back and analyze yourself and think about it. This is the first thing you have to do. After analyzing that also, you are convinced with the fact that you can be a day trader and that actually suits you, then you move forward. Proceed with that. Else, drop your plan and remain as an investor. Second step is you should select your trading style. Primarily, there are two approaches taken for day traders, and the first approach is scalping. Second one is the regular, typical day trading strategies. Scalping means this is the fast-paced trading approach, as the name says. Day traders who take this approach, they book small profits and exit, but the number of trades they used to take will be very high. But for scalpers, they should have a very keen on the market dynamics, because the risk reward ratio will be somewhat very close, maybe in 1:1 in that ratio. So make more number of trades, thus make profits. But on the other hand, the regular day trading strategies are almost like opening a position during the first half of the day usually and close it before the end of the day. So this involves a better understanding of the macroeconomic condition that can impact the market or the sectors. So it's all about identifying a potential trend of that particular day and take the position accordingly. Step 3 is you should create your own checklist, or you should create your own rules when you will take a trade, or when you will make an entry to a stock, or when you will buy a stock. What are the conditions should be met before you take the decision to buy a stock, or when you will sell a stock? Because we know that a lot of indicators are available there on the market. For each and every statistical tools, at least you can find 50 odd statistical indicators that may be slightly different from one after another. So you should well versed about the indicators and which are the indicators you are going to use and on what all conditions you are going to take an entry to any stock. All those things you should have a clear idea, and based on that you should make a clear trading plan on condition. It's almost like an if-then rule. If this indicator gives this signal, then buy. Usually most of the traders, or it's better always to go with the and rules. If this condition happens, this one, and this condition. It's not an or rule. If any of these conditions satisfied, you should not get into. If and only if all these conditions are satisfied, I will take a trade. That should be the approach. That kind of trading rules you have to set, because more number of trading should not be your objective. Instead, accuracy in trading should be your objective. Even nothing wrong in just depending on the price action. It is not mandatory you have to use all the indicators and get into some traps, because sometimes you may get confused with all these indicators, because one indicator gives one signal to you, another indicator takes another signal to you. So it's always you just do a trial run, dry run, and take the decisions. Else you start to work with some asset management companies until you get matured enough to take a trade. The fourth step in creating a trading plan is you should determine your risk tolerance. How much risk you can take. What is risk tolerance? This is a common term you might have heard everywhere. Every investment comes with associated risk. So if you are buying shares, then the price of the share can get influenced by various factors. So this includes the company's economy or social or political situation and the company's performance or its financials itself. So if the government makes a sudden policy change affecting an industry or a sector or in the entire market itself, then the share price will respond either in a positive way or in a negative way. That may go down or up. So risk tolerance is about the amount of risk, amount of money that you can lose if any unforeseen things or if market is not moving in your favors. We know that long-term investors have time to allow the prices to move up or down, but unfortunately, day traders, they don't have much time. They hardly have a few hours. So before you start intraday trading, make sure that you assess your risk tolerance, and you should have a clear understanding about how much money, how much funds, how much percentage of funds you can risk on every particular trade. The fifth step in trading plan that you have to include is about you should generally establish a trading schedule, and in that trading schedule itself you please include your frequency of trades also. This may be something like trading schedule or trading time, maybe in the forenoon session or in the afternoon session, or maybe in the peak turbulent time like 9:15 to 9:30. Some people may choose that time also. Even some people may choose to trade only after 10 o'clock when everything has been settled, the turbulence has been over that time. So whatever it is, make a trading plan and adhere with that trading plan. So it is very important for any trader to choose the time frame, the frequency, that means how many trades you have to take in each and every day. All those things should be. They should not deviate from that plan. The sixth step in creating a trading plan is about you should have a rule-based risk management as well as an exit rule. You should create an exit plan. At what percentage you will come out of that trade? If you fixed a percentage, profit percentage as 5%, adhere with that. Though the markets are favorable to you, then also never deviate from your trading rules. Never try to overtrade. This is what the step 7. Never overtrade. Sometimes in the first half an hour itself, you may able to generate or you may able to test your targets. You may achieve your targets to say maybe in the absolute amount of rupees or in the percentage wise, maybe 10,000 rupees or 5%, something like that. In that case, you stop your trading. Never think that anyway I have a lot of time, so let me trade. No, it should not be like that. Most probably, our trading will make you poor. Whatever you have made, maybe more than that, you will lose in the next few trades. So shut down your laptop and go for some other work. And step 8, that is nothing but learn to read the charts. So as a day trader, you will have to know the open, close, high, low, all those things usually, or majority of the people, they depends on the candlesticks, though there are many types of charts, but everyone prefer candlesticks. Whatever it is, it's not bothered, but you find your pattern, your chart reading methods, and you should try to be a master in chart reading. Unless and until you can be the master of chart reading, day trading or short span, even short-term trading itself, that may be a bit difficult, because majority of the time these kind of price movement in short term depends mainly on technical parameters, not on the fundamental parameters. So create the skills to read charts. Another important point is you should maintain a journal of your trades, a simple notebook or even an Excel sheet that serves the purpose. If you maintain an Excel sheet or any database tools, that gives you the flexibility to review that also at a later time. Especially this is very important for your failure trades. You can analyze what happened on that particular trade and you can learn a lot from that. You can learn a lot from the trades which hit the stop loss than the trades that hit the target. You learn something from all trades, whether that's that hit that stop loss or with the target. So finally, in short, each trader needs a precise trading plan for intraday trading. So you should create a well-arranged trading network in the initial periods especially and initial trades to become a successful trader in future. Moreover, one skill called presence of mind as well as a bit of analytical skills, both are needed to be a trader, to have a good command over your technical analysis. So I wish you a successful trader in future. See you in the next episode. Till then, bye from Anup.